Hi, this is Michael Fisher for savingandinvesting.com, and I want to speak a little bit more about dividends. Companies that have earnings, and companies when they make earnings, as we calculate from the income statement, where we take revenues, subtract operating expenses, and get to, in the end, earnings or net income or net profit, companies can do one of two things with those earnings. They can either retain them and keep them within the company for reinvestment or for investment needs or for a need to dispense cash or earnings, or secondly, they can pay them out as dividends. And the percentage that they pay out as dividends is known as the payout ratio. And the dividend then, from an investor's standpoint, is typically a cash payment that's received on a regular basis, very often in the United States on a quarterly basis, that we receive as a shareholder in that company. And it's a form of return that we receive while we hold the shares, and in effect, instead of having to sell the shares, we actually receive a cash return while we hold them. So it's a very important part of the return that we get as a shareholder. So a company can choose to do one of two things: either retain the earnings or pay them out, and we as a shareholder, if they pay them out, then receive a dividend per share for each share that we own, typically on a quarterly basis. Now that dividend is typically paid in cash, but it could be paid in shares, or it could be paid even in other benefits, but typically in cash. Some companies also do offer dividend reinvestment programs, where instead of receiving cash, effectively that payment is used to reinvest in the shares of the company, increasing the number of shares that we own in the company, and therefore the dividend is directly reinvested in the company. Now, when a company has an extraordinarily large gain or abnormally large profits, companies can also declare a special dividend. In other words, they might pay out extra cash on an unscheduled basis to shareholders. And conversely, as earnings drop for a company, they might elect to pay out less of a dividend on a cash basis in order to, as the earnings drop. So if a company had a certain amount of earnings and they were paying out 30% to shareholders in dividends, as the earnings drop, that same 30% would represent less of a cash payment, or as those earnings drop, they would probably have obviously less earnings and might want to pay out less as well. When we receive that dividend, we can calculate what the dividend represents as a percentage of the share price, and that's known as the dividend yield of the stock. And a dividend yield, therefore we can calculate what the return is on a pure dividend basis on the stock that we own. If a company's share price drops greatly and they haven't cut the dividend, sometimes dividend yields can appear quite high, because we take what is an old dividend or potentially an expected dividend and divide it by the new lower share price. But often these dividends can then be cut too, because the share price reflects a worse operating environment, or potentially an outlook is priced into the shares that is worse, in which case often the dividend may be cut. So that's on that is the subject of dividends, both from the standpoint to some extent of the company who is paying out a portion of its earnings, and from the standpoint of an investor or a shareholder who's receiving that dividend on the other side.